Well, the long end of the curve is not where the Fed has the most control, and that's where we've seen a backup. So with the long end of the curve steepening somewhat, you have to be mindful of what causes that. And one of the things that causes that is uncertainty on the future of inflation and where interest rates are going. And the Fed doesn't control that as much as they do short rates. So part of this backup we've seen here, I think is attention getting, and it's not really entirely about what the Fed's doing. And we do have inflation expectations priced into the TIPS market above 2% and trending higher. So it's not a huge problem. The level isn't bad, but the direction is something that the Fed has to pay attention to.
Yeah. Burns, do you see any of this altering the narrative that was written by Powell, at least at the last presser?
Yeah, I think that Jay Powell, for one, and the president has tried to put a little pressure on him. Jay Powell really has exerted his independence, and in hearing him speak, he does make good points. Then, I think that what the Fed's really trying to demonstrate is that they do want to stay out ahead of the curve. Now, granted, as the president stated, we don't have inflation today, but if you look at the trend level, average hourly earnings have gone up each of the last 3 years. And what do they say about inflation? They say it's like toothpaste. Once it gets out of the tube, you can't put it back in. And so that's why the Fed does really want to stay out a little bit ahead of that.
I guess, Kevin, the question is, we're not seeing any of that. I mean, the president has a point. You've got today's PPI numbers out. Wholesale inflation doesn't show any worrisome sign of breaking out into anything dangerous. Is the Fed moving too fast or preparing to?
No, the Fed's not moving too fast. If you look at where short rates are today, just over 2%, look at the past peaks in short rates. They're much higher than where we've been today. So with the Fed, with short rates just about where the forward look on inflation is, they're more neutral, I guess, than they were a year or so ago, but they're nowhere near what would be considered tight. And so if you look around, look at the performance of asset classes, look at the performance of the economy in general, it seems like the Fed is actually has done the right thing. And by restoring something of a positive interest rate, it gives them a little bit of ammunition should something go wrong down the road. So the Fed really does need to address tightness in the economy by raising interest rates, and they're just simply going about doing that.